morning to all the people present over here. As you are already aware that PFRDA uploaded the consultation paper on the 3 proposed pension schemes, and which is out for the feedback of the people. In that regard, we are having a small seminar on the consultation paper of the enhancement of the national pension system, in which, as the day proceeds, you will notice that we have called on a few speakers who are academicians, researchers, and retirement income practitioners. There will be 3 presentations, and to give you a brief and to set the context of today's meeting, I'd call on stage our Executive Director, Sumit Kaur Kapoor, ma'am. Ma'am, stage to you. Thank you.
Thank you so much, Pradeepto. Respected Chairman, sir, respected whole-time member, law, sir, and esteemed speakers who have come here from various parts of the country and also abroad, Professor Arun Muralidhar, and colleagues from the pension fund industry, insurance industry, actuaries, and academia. On behalf of PFRDA, I extend a warm welcome to all the dignitaries who have come to attend the seminar on the consultation paper, which is basically on the decumulation phase. So we are all aware that PFRDA has been the regulator of the pension funds, and basically what we have been dealing with is the accumulation phase, the investment part of it. However, it is felt that the pension regulator should deal with a pension product which is end-to-end. So from the cradle to the grave, so as to say. So it has to be seamless across both the phases. So in today's dynamic financial landscape, subscribers require pension systems that align with their personal retirement goals, offering flexibility, security, growth potential, along with a level of certainty in income. So that's what we are looking at. With increasing longevity and economic uncertainties, pension structure need to provide more than traditional savings. They need to deliver structured, adequate, reliable income streams to sustain subscribers' quality of life post-retirement. So what we are looking at is a certain income which is adequate and is also probably inflation index, so that the standard of living is maintained. The current NPS is a transparent, mark-to-market defined contribution pension scheme that emphasizes fiscal prudence and largely focused on the accumulation phase. However, from the subscriber's perspective, it leaves certain questions unanswered, with the adequacy of the corpus and the predictability of the retirement income due to factors like market volatility, contribution persistency, and investment choices. To address these points, a concept paper on the matter of offering schemes of pension funds and covering both the accumulation and the decumulation phase of the pension scheme had been developed as a market development tool. Now, the aim was to generate interest for deliberations amongst the academics, pension funds, and other stakeholders to come out with the suggestions for development of the pension market in India, and also to encourage pension funds to design pension schemes which cater to the requirements of the subscribers. Now, we are all aware, you've all read the scheme, and there are 3 schemes that have been proposed. And these schemes enhance the existing NPS framework by addressing diverse subscriber needs, including wealth maximization, assured benefits with inflation protection, and predictable retirement income through innovative mechanisms such as the pension credits. I think you all have read the 3 schemes, and Pension 1, the scheme first is a non-assured scheme focused on maximizing pension wealth through a mix-up of step-up systematic withdrawal plan and annuity. Pension Scheme 2 is an assured scheme providing a target pension with periodic inflation adjustments. And Pension 3 is an innovative concept called pension credits based on the idea of goal-based investing. Each credit assures fixed monthly pension payouts in the accumulation and the decumulation phase. So I'm very sure that these schemes have been widely read, and we expect a lot of queries and feedback on these schemes. Now, we have an esteemed set of speakers with us. They would be making the presentation. And of course, we also expect a lot of feedback on the presentations that have been made. And this would lead to actually, development of these schemes on the ground. So I would not stand in the way of these presentations. Thank you very much, and we expect a very productive deliberation. Thank you.
Thank you, ma'am, for setting up the context. Now I'd like to call on stage Professor Arun S. Muralidhar. It's my absolute privilege to welcome you on board and to give you context. Professor Arun is a co-founder of M-Cube Investment Technologies LLC and a client CIO Alpha Engine. He holds a PhD from MIT Sloan School and BA from Warburg College. And he has 2 award-winning bond innovations in retirement and child's education that are currently applicable in Brazil. He writes extensively on pension reform, asset allocation, pricing, and portfolio currency management. Some of those recent books are A Noble Retirement, 3 Noble Pillars and 3 Facets, Investment Theory and Practice, and GBI, Give Me Better Instruments, or Goal-Based Investing. Now I give the stage to Professor Arun, sir. Please give a round of applause for Arun, sir.
Thank you very much, Pradipto, for that introduction, and thank you, first of all, to Chairman Sir Sumit and the rest of your team. It really is an honor and a privilege for me to come back to my hometown, but more importantly, to be surrounded by such a talented team that you have at PFRDA. I've been doing pension reform for 30 plus years, and this is probably one of the best teams I've ever dealt with in these 30 years, so congratulations, and it's really a privilege to be here. I'm going to share a few thoughts, as I said, because I've done pension work for so many years. Just a little bit by way of background, I started my career at the World Bank issuing bonds for them, and then I switched to managing the pension fund. This was in mid-90s. And I started a big fight with the World Bank, which, if you may remember, back in 1995, had talked about privatizing Social Security and taking the Chile model all over the world. And it was immediately obvious to me, because I was managing the pension fund, that it was only going to move monies from poor people to rich people, and it wasn't going to give people a secure retirement. And that led to me writing a book, which I'm going to leave as a gift for all of you. And there will be a quiz afterwards, because I'm a professor as well. But interestingly enough, in reading your consultation paper, which I really absolutely admire for its ambition and the vision that you have for what you can achieve, it also touches on this most recent book that I wrote on goals-based investing. So in the few minutes that I have here, I'm going to try to stimulate a discussion, not only on the schemes that you've identified in your consultation paper, but also some ideas around goals-based investing that may help you build a better system in the country as well. So very briefly, my agenda is hopefully quite simple. I'm going to start with what I found very well articulated in the consultation paper, which is what should be the goals of the NPS schemes. And then I'm just going to touch upon what are the challenges that you have in defined contribution pension schemes, because this has been an ongoing problem for over 30 years in the world, and people still haven't solved it. And again, I commend you for actually taking that step, because even in developed countries like the US, Australia, and the UK, they still haven't solved a lot of these problems, which ultimately is going to lead to many people retiring poor, which is not good for any country. Because I've spent 30 years also doing goals-based investing, I'm going to give you some concepts that I've articulated, which hopefully helps you build better regulation. And fundamentally, goals-based investing starts with what are the cash flows for why we invest. And it's interesting, there are a couple of Nobel Prize-winning papers that don't even talk about goals while talking about investing, and so they're fundamentally flawed as well. Then I'm going to talk a little bit about the 3 schemes that you've articulated in the paper. I noticed Ravi Sarogi is one of the speakers who's done a more quantitative analysis, so I'll leave my comments as more conceptual as ways to stimulate the discussion. And then again, because I'm a professor, I put a little scorecard together of all the schemes, again, to help you decide how this can evolve. And if time permits, I'm happy to talk about my idea for what I think India should do, which is issue a bond I called India's, which is an inflation-linked deferred income annuity-like security. Brazil has done this very successfully. They're winning awards around the world. And I literally just came from Turkey yesterday where they want to do it. Chile has adopted it. There's no reason why India cannot do that. I love acronyms, as you can tell, and what I took away from your consultation paper, literally on the first page, which was superbly articulated, is that if we fundamentally understand that a retirement system is meant to allow people to have the pre-retirement lifestyle in retirement, then that's a simple statement of a goal, right? So we don't need to get very technical in stating what the goal of a pension system should be. But then it drops down into certain other characteristics, and I use the acronym SARI flips, which stands for, as Sumit mentioned, structured, adequate, reliable income, so that's your SARI, and then flexible, liquidity, inclusion, portability, and simple. And I think in a lot of cases, the simplicity gets ignored as you allow enough finance professionals to sort of mess with the system and make it complicated so that you get higher fees, and then that doesn't serve a population like India for sure, right? So I'm going to work with that as the basic structure by which I'll evaluate each of the schemes, and hopefully it gives us a little bit more structure around how to think about making these a reality as well. At a very high level, the challenge with defined contribution pension systems, and as I said, I used to manage the World Bank's defined benefit. I had some of the smartest people in the world working for me. We were managing $10 billion back then. And my own defined contribution after I left the World Bank is terribly managed. You know, I've got an asset management company. I make investment decisions every day, but my own defined contribution is a complete mess. And it's a complete mess because the math required to get a good pension is extremely complex. Because you have accumulation, you have compounding, you have inflation, and then you got to work out decumulation. And one of the best papers written on this topic is written by one of my co-authors, a Nobel Prize winning gentleman by the name of Robert Merton, but you need a PhD in physics to work it all out. So how do you create a good pension for people in India who are either driving an Uber or helping clean your house or something like that? And the challenge was, and this is why I started the fight with the World Bank 30 years ago, was when you go from DB to DC, you're now transferring the risk to individuals who are not financially sophisticated, and they have to get that decision right in one lifetime. In a DB, you have a multi-generational sort of risk sharing, which allows you to have periods where things can go wrong, and then there's some ability to share the risk with other cohorts. But then the investment decision is extremely complex. It's not just about what assets do you actually want to buy, but how do they change dynamically over time? How do you rebalance? And as I said, I'm an investment professional, and even I don't get it correct. And then comes the even more complicated decision, which is how do we decumulate? What annuity do we buy? And the moment you have multiple parties involved in this, that's when the costs start to get elevated, which means you get a lower pension. And the fundamental challenge globally is if you only have nominal annuities, then your real standard of living actually declines over time. And again, this is something Nobel Prize winner Bob Merton has talked about a lot. Chairman, so your comment about we've got UPI for payments, why not UPI for pensions? I'm stealing it from here on out, because that's really what it has to be. If everybody's functioning on a mobile phone today in India, you have to deliver your service on that platform as well. So I think I'm glad you're taking that idea. And Brazil has actually done that. They have their version called Pix, and it has worked out quite well. Just very quickly on GBI, this is something that, as I said, in a lot of the academic Nobel Prize winning lectures, you don't see that because the first box is missing, which is why we're investing, right? Whether you look at the Markowitz, a paper in the 1950s or the Bill Sharp paper in the 60s, they just ignore why we're investing. And the investment is because we want a series of cash flows, whether it's for sending our child to college, whether it's to buy a house, or in our case, for retirement. And so one of the things that I developed with a lot of Dutch pension funds in the DB space was we converted those cash flows into what we called an investable liability index. And why do we do that? Because once we can measure the valuation of the liabilities daily, then you can make sure whether the assets are matched appropriately or not. And you as a regulator, and the Dutch regulator is actually very, very sort of rigorous and detailed in their analysis, monitors how much tracking there is between the assets versus the promises you've made, and that determines how they can either give a pension fund an up or a down signal and corrective action. So the problem you have is if that tracking error is high, we call that tracking error, the risk between the goals and the assets, then you have a couple of challenges as a regulator, which means most likely either the obligation will not be met or it's going to lead to high cost and low flexibility. And that's what led me to come up with this idea that we need new instruments. That is, rather than making the investment strategy more complex, is there a way to create a new instrument that's a win for society, but then also simplifies? And so, as I said, if time permits, we'll talk about this idea for what India could do to greatly sort of simplify retirement investing. And I really love the little thing that the little visual that you had in your consultative document, because if you can deliver this to the average Indian person, that here is my goal, it's 10,000 rupees per month or whatever, and translate that into a tangible idea, which is just buy 1,000 of these instruments, that's how simple we should make retirement investing, right? We shouldn't be talking about various. So I think you've got lots of interesting things, and I'll talk about where I think this could work. Just very briefly, why do we have such a problem in defined contribution pensions around the world? The chart on the left is your typical cash flow for, let's say, my 25-year-old son. So my son turned 26 yesterday. And he doesn't need cash flows till he turns, let's say, 65. And from 65 onwards, he just needs a steady stream of cash flows in real terms, right? So that's the cash flow profile that he's trying to get at. Because all of finance theory started with this idea that's let's trying to maximize wealth, all the financial instruments in the market are about maintaining wealth. And so your typical bond that you would buy has a whole bunch of coupons when my son doesn't need it. Suddenly a big fat principal payment before he's even retired, and then he's got to do another 60 transactions to move that over. And as a result, you essentially have a flawed system that's guaranteed to give bad outcomes, right? Now, what I'm going to show hopefully is that it does make it hard for pension fund providers in India to hedge if these instruments don't exist. But maybe if they can pool large numbers of people, they start to behave like a defined benefit, and it gets a little bit easier as well, right? So this is the fundamental problem we have globally, which is the cash flows required by the retirees is very different from the cash flows offered in the financial system, and that creates inefficiencies and high risk for retiring poor. Let me just quickly touch on the three schemes. And again, as I said, your team has done a superb job in articulating these schemes, because each one has its own creative elements. And I think the first one, as Sumit mentioned, is the maximizing wealth objective with the systematic withdrawal and then an annuity. And I'll let the folks read into the details of the system, but just for my own thinking, I had to break it down by these parameters, which is what is the key aspect that you're trying to achieve, what are the contributions, what's the time, what's the investments, decumulation, and then any survivor benefits. And the only thing I would caution against, and maybe there's more work to be done, is the typical life cycle products guarantee absolutely nothing. In fact, you can even prove that a life cycle product's outcome is a function of your date of conception if you work the math backwards. So be very careful that you don't follow the terrible life cycle products created in America, which currently have 3 trillion of assets and have been given a regulatory blessing. They're really horrible products, and they're just making companies like BlackRock and State Street very rich, leaving all the risk on the individual. So I think there are better life cycle funds that we can help develop together that actually help people achieve the goal that they're trying to make. Because the problem in the life cycle funds is the rebalancing is completely independent of the outcome. The rebalancing is based on age, and that means nothing from an outcome perspective. So I think India can develop a better system of life cycle funds that don't copy the mistakes of the West. And the challenge you're also going to have is the moment you have annuities with survivor benefits, then it starts to make it complicated. It starts to make it more expensive. And you may want to think about how you may want to adapt that. The other last point I'll make on this is you had a very sort of systematic withdrawal of 4.5%. And I shared a paper with you which I think is an interesting idea, which is how can you create a self-annuitizing formula so that rather than a fixed 4.5%, the amount that's paid out ensures that the portfolio is never sort of depleted, and I think that might be a slightly more flexible system. But the challenge with the SWP is that you can't guarantee an income level, right, because it's adapting to the portfolio. So there's some nice ideas that you can use to, I think, make this a much more powerful structure that you have in place. I love both 2 and 3. I'm completely in love with both of them because, A, I've never seen them before, and I think the team has done a nice idea of articulating them. First, the idea of splitting it into 2 pools is really nice. where the bond pool is about giving you real cash flows, and then ideally pool 2 is the inflation adjustment. The only thing, again, I would caution against is equities is not always the best protection against inflation. So there may have to be, in India, you're very dependent on the price of oil, so there may have to be commodity exposure, something like that, that actually could make this a much more effective product. But again, the challenge, if you're trying to protect real standard of living, then the assets in that risky pool have to be appropriately managed as well. This one, again, I'm very biased. It smells and feels very familiar to my own work. But again, I think what I love about your team is that rather than trying to address the entire 20 years in one slice, you've actually broken it up into smaller slices, which is very creative, and congratulations on doing that. The only issue I have with this is I would not let the pricing be done by the pension funds. I think either PFRDA or the Ministry of Finance has to establish a price, because otherwise there cannot be a secondary market. In fact, this is the problem American regulation has, is every pension system today is required to report the likely retirement income, but everybody can use whatever discount curve they want. So two pensions with exactly the same assets can pretend to have very different retirement incomes that they guaranteed, and that just makes it very arbitrary. So I think you have to step in, or some other agency has to step in to say, here's the pricing for such and such pension credit, and it's based ideally on a market price, and that allows for people to then potentially trade that in the secondary market as well, right? So again, I have my scorecard. I won't discuss that. We can talk about it later on. But I think by and large, this is how I was trying to see what are the pros and cons of each strategy, and therefore how can we make each one of them a little bit better than the high-level framework that you've laid out by ideally putting more details into each of the topics as well, right? I just wanted to give you an example of the pricing matrix that you could maintain, because in America today, I have no sense of what my retirement is going to cost. And because I came up with this idea of a retirement bond, I'm able to price the bond in America every day. And so I've created a new index with one of my colleagues, which then tells people, what does it cost for you to be able to get $10,000 real per year? And that way, I'm now becoming the agency which I think the American regulator should be, so that people can see that when the central bank cuts interest rates, the price of retirement is going to go up. Today, you don't have that sort of transparency, and so there could be a lot of policy mistakes that are made that could affect retirement income. I think for your 1 to 5 year window of pension credits, maybe develop a model, publish it, and say this is how the pension credits will be priced. And that's going to, I think, make it a lot more simple for the rest of the people to follow. And there's a lot of uniformity in how these calculations are being done. The only other thing I would do is the formulas that you have for discounting the pension credit portfolios is very complex. And I think once if you create this price, then you can take the NAV of the equity portfolio, the risky portfolio, and immediately transform it into an instantaneous pension credit. So report everything in pension credits. It's a very simple calculation. If you do it this way, the discounting of your cash flows for risky assets and whether it's levered gets more complicated than I think is necessary. And there isn't a good enough economic or financial grounding to that discounting as well. So stick with market pricing. It's much easier, much less work, much less sort of conflict later on. All that brings me to, do I have a couple more minutes? Yeah, sure. All that brings me to is the idea that I think India should definitely launch, and I've been talking to people in the government as well, Ananta Nageshwaran being one of them, the chief economic advisor, and also TV Somanathan, who's the cabinet secretary. This is a bond that India has to issue at some point, because otherwise you can't have retirement security, and you can't have funding of infrastructure or capital market development. And so let me just describe it for you in 2 minutes. The idea behind the bond is that the bond pays nothing till you turn 65, and then at age 65, it pays you, let's say, 5 rupees real per month for 20 years. Let's assume that's average life expectancy. Why did I design this bond was if an Uber driver says, I need 5,000 rupees in today's terms a month for retirement to be secure, then again, the goal is just buy 1,000 of the bond. So it's very similar to your pension credit idea. And the way it's designed in Brazil is it gets paid directly into your bank account on the same day that you get your Social Security payment. So it's literally just seen as a supplement to Social Security. And the bond is basically an individual defined benefit, right? So rather than the complicated calculations of what should your contribution be, what should your rate of return be, all of that, all we're trying to do is make sure that people can buy this bond off a phone by literally pressing a button. And in Brazil, you can buy it in slices of as little as $1 at a time, which is about 80 rupees today, right? And it's liquid. So if you want to sell it because your child goes to the hospital, you can sell it instantaneously as well. And if you die young, then your heirs inherit it. I think you've done something really creative by saying, don't get me a bond for 20 years, let's break it up into 5-year slices. And I think that's really, really a brilliant idea, and I congratulate you for doing that as well. Just very quickly, what this innovation allowed Brazil to do, and if it happens in India, could be used in the pension system, is Brazil created an education bond as well, which pays nothing till your child gets to 18, and then pays you 5 years of same real cash flows, inflation indexed. So if we can get the government to issue the education bond as opposed to the retirement bond, that becomes your pension credit, right? Because it'll pay nothing till your start date of your retirement, 5 years of cash flows. And it's really democratized what's happening in Brazil. They had 190,000 people voluntarily start to buy these instruments who had never participated before. They raised something like 7.7 billion out of the retirement account. 350,000 people immediately sort of bought this on their own. So you can actually get rid of behavioral biases, and it also achieves multiple social goals in India. So I hope at some point other parts of the government come and support you in the work that you're doing, because you can actually transform the future of this country, not only by giving good retirement security, but allowing for capital market development and long-term infrastructure funding as well. So with that, I'll stop, and I'm happy to take any questions, and I hope that gave some ideas for further discussion as well. Thank you.
2021, is it peaking? 2021, I see that the amounts are higher at the higher level.
Because you had negative real interest rates in America. So when the central bank pushed rates into negative territory, you were buying $200,000 worth of real cash flows, but with negative interest rates, you're actually paying more than $200,000, right? So the central banks, when they were pushing interest rates extremely low, were claiming that they were using that to support the economy, but it's coming at the price of your retirement security.
Okay.
And because this price was not transparent, nobody mentioned it. But we've seen a decline in the quality of life of old people because they couldn't buy that, right? So this is why I've created this index, so that let's make it very transparent as to what is the cost of buying my retirement security, right?
And secondly, when it comes to the bonds, where does the money come from? It comes from the capital market?
Yes, so currently in Brazil, it's sold entirely in the retail market. Our idea was to also have an institutional issuance. So the pension funds in India could actually buy this on an institutional size by aggregating all the people in their cohort by age, right? So there'll be multiple sort of instruments that they can buy, both institutional and retail.
So my doubt over there was that when you come to a NatCat bond and things like that, there is an image, I mean, there is an uncertainty somewhere. Here you have a certainty.
There's only certainty of cash flow, but the interest rate is changing, so the price is changing dynamically, right? So what I was trying to do is, if I give certainty of cash flow, then people can plan their retirement, but that doesn't mean that the interest rate that they lock in or the price is guaranteed, right? So that can actually change quite dramatically, as you saw on the other slide. But at least now somebody knows where they are relative to their goal, which is if their goal was 1,000 of these credits and they're only at 300, either they have to save more, invest more aggressively, or postpone retirement. So you can actually give people very helpful advice on what actions they can take to get a good retirement. Today, you get nothing on your statement, right? So that's what we were trying to do. It's not perfect, but we're trying to sort of move it in that direction.
Trying to understand.
Okay, thank you.
Yeah. Your earlier slide was showing that NAV will be converted into pension credit.
Sorry?
NAV will be converted into pension credit.
That's correct.
Okay, so pension credit will be as good as like bond, or it is going to be listed in a bond market, and there will be volatility subject to market changes. then if such things are going to happen, then suppose somebody is looking for 1 lakh rupees down the line after 20 years as a pension, then how many credits he has to buy, pension credit he has to buy?
Correct.
And how it works?
So in my ideal world in India, there's actually a bond that you can call the pension credit bond, or you can call it India's. Because I think without an actual physical instrument which has a market price, any other calculation is arbitrary, right? At which point pension fund one may complain saying that you've priced it too poorly, and therefore what the person is expecting from their pool of funds is more than what we can deliver, right? So it'll cause, I think, a lot of problem for the regulator, because they're going to be fighting with all the vendors who are going to complain about it. So this is why I think other parts of the government have to support the pension industry by saying, if we don't create an instrument which has a transparent price determined entirely by the market, no subsidies, no interference, that's the only way in which you can then do these simple transfers. And then once I buy those bonds, that income is always guaranteed. One of the reasons I also designed this bond is when Trump came up with his ideas about tariffs for India, the stock market declined dramatically. People open up their retirement account and suddenly they panic and they sell, right? If you had these bonds, the cash flows are unchanged. So actually in Brazil, when the market went down, they found people actually buying more because they felt that they're not any poorer in retirement because the cash flows are locked in. So it removes the volatility of the statement that you send to people, and therefore you remove the behavioral biases to do stupid things at the wrong time, right?
It will be issued by the corporate or the government agency?
So ideally you'll have to do government to start, because if you want to develop a benchmark curve, it typically has to be the government. And I know that because I used to issue bonds for the World Bank and we were AAA rated. So we were very often the benchmark curve. Once the benchmark exists, then you can have insurance companies, infrastructure companies issue with a little bit of a credit spread as well.
If government is going to issue, then it will be known as a GSEC bond or something.
Exactly.
Okay.
Yeah.
Then there would be some benchmark return, like 7%, 8% is assured. And then afterward, it would be subject to market conditions, market volatility.
Right.
Is it like that?
Exactly. So when Brazil issues these on any given day, they quote the price and the real yield that you're going to get if you bought it instantly. But 2 days later, the yield could be very different, right? Because the prices are moving. And you want that, because that's part of the market behavior. So we made it very clear to Brazil, don't subsidize the instrument, because then you'll ruin the information of what the market is willing to buy or sell at that price, right?
So now you quoted the case of Brazil. Apart from Brazil, is there any other country where, this kind of mechanism, the US is there, okay, US and Brazil, then is there any European country
So in
where
fact, I'm talking to the UK government, because in the UK what they have is they have a lot of people who are self-employed who are not part of the system. And they also have another system called Nest, which is for smaller companies. The problem again is there's complete uncertainty of their pension. So I've actually been advising the government, and we submitted a comment to the Pension Commission to create this. Chile has actually done it, right? I just came from Turkey yesterday. The pension regulator wants to create something like this. I just presented it to the Kingdom of Saudi Arabia because these are also Sharia compliant instruments, right? So in a country where we have a large Muslim population, if they want to do something that's Sharia compliant. So it's now becoming more popular because the Brazil model has proved that this actually works. Right? So now that's why I think India could be one of the leaders to start to create it and make an even better instrument than Brazil made as well. Right? There's still room for improvement, which is where India can actually be the innovator.
Hello. Yeah, from this side.
Oh, sorry about that.
Yeah. So this is Sanjay. I'm from the insurance side, basically, and now on the tech side. My question is that now there is always being a dead-end kind of retirement. All the credit score are mapped to CIBIL score. There is no post-retirement if you are getting the pension and all these things. Despite of that, people are not happily not extending their period for a loan duration. Do you think that there will be another kind of credit score, just like CIBIL score, there is another credit score is required? Those who are the pension fund holders or anybody, they have extended loan durations. Let's say, that the perpetual, even if I get retired, I'll get certain amount of money. So CIBIL score is end, but there is There is pension fund is going to start. Why can't be there eligible for 75 years of loan?
Right. So remember today when you say if you have a pension, you get something that's guaranteed, it's only guaranteed in nominal terms, right? And the reason as an insurance company you cannot offer real indexed annuity is you don't have a hedging instrument, right? So if the government doesn't create this instrument, even the insurance companies are going to have a problem because then you cannot have real instruments that hedge your risk, right, for your balance sheet. So this will allow the regulator to actually be able to score companies more efficiently on how they've actually hedged themselves, right? Without this instrument, it's going to be very hard for you to offer real life annuities after, whatever payment period that people want. So you're going to have different credit scoring based on how well people are matching the liabilities of what they've promised to their clients. Pension fund or insurance company. To me, a pension fund is just an insurance company with a different name, right?
Yes.
So,
but I still feel that there is a opportunity, just like civil score, we have to create another score for retired people. Maybe not only for retired people, those who have a civil score, good score, and post-retirement there is a good planning, then after 60 years, maybe the retirement credit score, based upon that score, the loan amount duration can be extended. That is absence now.
I would agree. In fact, one of the problems we have in America is you're given a good score if you have this silly life cycle product.
Yes.
It's a terrible rating system, right? Whereas it should ideally be based in a pension fund or an insurance company on what is the amount you are guaranteeing somebody relative to their target. So that's what I would score a pension fund on, is how good are you at delivering what you've promised your client. That should be the scoring mechanism. I would agree, yeah. Thank you.
Thank you.
Good morning, Anubhav Chattaraj here from PwC. Just coming back to the idea of India's and pension credits, because they're very similar. In the structure that you have envisaged, is there any room for, or do you think that different pension fund managers would end up investing in different baskets of assets, for instance, PFRDA? And if so, how? If there's a market-based mechanism for pricing, do you envisage different prices for different kind of asset buckets? And if so, is it a guaranteed product still? Because from the subscriber's point of view, if I'm purchasing the same guarantee, it's not really, the moment I've purchased it, it stops being my concern how that guarantee is being met, so to speak.
So that's a terrific question. So remember, this is only looked at as the safe asset of retirement, but you're obviously going to want to mix this with stocks and maybe gold or whatever other assets you want. So I've published some papers on what are the interesting dynamic rebalancings that you can create in multiple assets given that the client specifies a goal, right? Now, the only amount that you can guarantee as a provider is what you've bought guaranteed that locks in the cash flows. Whatever is in stocks is not guaranteed, right? It's only guaranteed as of the day that you convert it into a pension credit. The next second, it's actually no longer the same, right? So this is where the regulator will be able to say, yes, this is a product that's guaranteed the minimum threshold because they already have locked up those cash flows. Anything above that becomes extra for a better quality of life, right? Now, if you're a young person, you may want to hold more equities. But if, at some point you have more in your portfolio NAV than was needed to lock up your lifestyle, I would say just immunize it and, stop playing around. And then once you've immunized the balance amount, you can put in crypto also if you want, right? So I think this whole concept of how do we lock in people's retirement guarantee, and then whatever happens with the balance assets can be in a wide variety of assets. It doesn't have to be restricted to just this instrument, right? Does that make sense?
It does, but the question was more around once the assets get locked, do you really, is there a sense in settling a bond tied to particular investments? Or in any case, once the bond is purchased or once the pension credits are locked, the actual investments backing it become irrelevant to the policyholder because the risk effectively gets transferred.
Yeah, exactly. Yeah, because the whole contract should be exactly that. Is the policyholder has no sort of financial knowledge. They're contracting with you for some kind of a guarantee. The question that the regulator has to then ensure is that how do they make sure that what you've guaranteed versus what this person understands is compatible. It gets complicated if you don't have a market instrument that allows them to say, yes, this is what they've done. We looked at their portfolio. They have exactly the cash flows they need to make that guarantee reliable, right? So that makes the regulator also more effective in their job of making a clean system that can help everybody, right?
Hello, sir. Alpna here. Sir, in Brazil, like...
Little.
Hello. Yeah. Sir, in Brazil, as in your paper, the guarantee is provided for 20 years in post-retirement period. So, if a person outlives that, suppose in case of India, it is 80 years. So, if a person outlives 80 years, so how that longevity risk would be addressed by your this model?
So there's two ways. One is that, well, three ways actually. One is that people who have longevity expectations that are going to extend beyond that, right? So I'm not, because my father died young, I'm a heart patient. I don't think I'm going to even need 20 years. I don't need to do anything else. But that's where the insurance companies can offer deferred life annuities, because there are instruments by which they can hedge that offering. So that's one. And it's going to be very cheap because it's deferred to paying out after 20 years compared to buying it at 70, right? So annuity pricing comes down. The second thing that Professor Merton and I recommended is, if these bonds are issued, then an insurance company should be willing to say, just bring me your 20-year cash flow, and if I have a diversified enough pool, then my experience as the insurance company is the average longevity of the economy. So they should be willing to trade one of these bonds for a life annuity, but give it a little bit of a haircut for the risk that we may outlive that, right? So let's say this bond pays 5 rupees. When you go to the insurance company, they'll say it's 4 rupees and 75 paisa, right? The third idea which I had is I'd also created another bond called the live bond, which is called the longevity indexed variable expiration. It's very technical, but that would cover you for whatever stub of your specific cohort. So the hope is that at some point Brazil then issues that to allow for longevity indexation. But the bulk of the risk is in the cash flows during the 20 years of average life expectancy. It's typically a rich person's problem to have longevity, right? Because all the statistics and demographics is that the poor and the minority people have average longevity well less than the economy average, right? So that's why we designed this bond more to cover the poor for sure, and then hope that the private sector creates new instruments like longevity life annuity as well. Does that help?
Oh, yes. Thank you. Thank you.
Sir, here.
Okay.
Yeah. So, sir, my specific questions was with respect to Scheme 2. Means you talked about it. Means while we were trying to decipher it, it also talks about projection of inflation during the deaccumulation phase, right? And that's one challenge we thought, maybe if you can say how sitting today, 25 years hence, is that a challenge you see in, how can we address that, sir?
So in fact, that's why I would argue that the government has to issue that instrument. When you buy the instrument in Brazil, you never have to forecast inflation ever again, because it's going to get paid in that instrument anyhow. So it's the perfect hedging instrument. If you don't have that perfect match, then you're playing a guessing game with assets that are potentially risky. And again, it'll have to be the individual that bears the risk. You as a pension fund cannot bear that risk. So there's a lot more complexity that comes into that structure. It's a beautiful structure in how to split the portfolio, but you're going to be handicapped if the perfect inflation hedging instrument doesn't exist. So you're correct about that. Forecasting inflation I've worked as a macroeconomist, it's incredibly terrible, right? I'm really bad at it. Nobody is good at it. Even the Reserve Bank of America couldn't forecast inflation. So if they can't forecast inflation, nobody can. That's why you need good instruments that embed the inflation and remove us from the business of trying to forecast it. Does that make sense?
Sir, just to add to that point, now the government had issued sovereign gold bonds, which was in a way an effective currency, because all of the investment which is happening today is in rupee terms, so there is a risk that your currency depreciates sharply and inflation happens. There is open. Government issued sovereign gold bonds. What happened was the risk was transferred from individual to the government, but it was not backed by the asset, which effectively led the government being short, and if they would have continued, it could create a systemic risk.
Yep.
Now, with the inflation index product which is suggested, the risk will probably get transferred to the government, and it can be an intergenerational risk hazard. So rather than So then an alternative way to look at it is, in a guarantee which we are providing on the day of deaccumulation, the risk appetite is again in the reverse cycle what it is today. So when you're starting, your risk appetite is higher and it ends lower on maturity. But from the day of your maturity to your longevity at 95, let's say, from 60 to 95, your risk appetite for the cash flow on the 95th year is significantly higher?
Depends. You cannot make an arbitrary statement like that, right? Because our risk preferences are so dynamic. Right?
No, so I would want to rephrase then that.
Okay.
As the time horizon is higher, the ability to take risk for that cash flow, for that longevity risk could be slightly higher than what it is
Ostensibly. Ostensibly. It depends on each individual's risk preferences, right? So on a general basis, I'll agree with you. On an individual basis, not necessarily.
Fair enough.
Yeah.
So then, so combining, instead of 2, combining 1 and 3 in that sense, in the pension credit segment, as of today, there's a product which an institution can do by stripping the government bonds, which is available. So nominal terms are not real terms. So the first 5-7 years cash flow, which needs to be certain, it's in the zero coupon strip or whatever. And as we go ahead, there are target dated funds for that cash flows. And as suggested in 3, then on the day of deaccumulation, the cash flows can be mapped as required by buying on that day.
Correct.
So you can have a partial guarantee for the early years and map it for the...
So the only challenge with, so let me take 2 questions. First was in the structure of the bond, right? What Professor Merton and I recommended, which is based on a paper he wrote in 1983, is don't just index to inflation, index to standard of living. So what that would mean in India is that the bond should be linked to a GST index. Why? Because then the government is hedged. Their revenues are in GST, their outflows are in GST, there is less risk of being short an asset, whereas with inflation, they do have that risk. So in an ideal world for me in India, which would be a really innovative product, is it would be a GST-linked bond, okay? So that's one. The problem I have with stripping and then creating these structured cash flows that you need is that then you can't have liquidity, right? Because if you want to have a secondary market, if your client comes and says, I need to pull it out, you need to sell a really small slice of that strip, which is going to be incredibly expensive, right? So this is where, if people want the strip, why shouldn't the government just issue that strip itself? That was my argument to US Treasury, is if the street is stripping it and doing all this complicated financial engineering, that means that there's an end demand for that structured cash flow. Just issue the bond that has that cash flow. If it's liquid, then you'll make the market much more efficient, right? Okay. And as a regulator, then it's very easy for them to count and say, you're retiring in 2035, and you had a target of 1,000 of these pension credits. We've locked up 900 with the bonds. You're short 100, right? Today, for them, they're going to have to sit down and look through every balance sheet to see whether you have the right strip composition. It is much too complex. It's very intensive from a regulatory perspective. And it'll chew up a lot of the time of the pension funds and the insurance trying to prove to them that you've actually got effective asset liability management, right?
Okay, thank you.
So you can improve the efficiency by just a little bit of creative issuance of financial instruments, right?
Okay.
That's the idea.
Yeah, thank you.
Thank you. By the way, these are all superb questions. I'm really stressing out in answering them. So,
yes, just extending that point. So, if you look at the insurance market today,
just a little bit louder, sorry.
Yeah. So, if you look at the insurance products available in the market today, so we do have products where there are guarantees stretching up to 40-50 years. And as we wanted that the cash flow should start from a particular date, say after 20 years. So, those structures are also available. So, in terms of the cash flow requirement, there are products available in the market. So, with respect to the ask for a specific bond from the government, so right now, so only thing which I want to understand is, right now the reinvestment risk lies with the company. Because these are coupon-bearing bonds and the reinvestment lies with the company.
Absolutely.
And if we have a structured bond issued by the government itself, then we kind of mitigate that and we don't have the issue or the risk on us of reinvesting that money.
Absolutely.
So that's, just wanted to clarify on that.
Absolutely correct. And the thing is, today, to be able to get that forward starting cash flow, you're probably using FRAs or some other instrument. My point was, if that's what the retirement industry needs, and in India you have 1.5 billion people, that's a lot of demand for a liquid instrument. The government will make both your side of the fence more efficient in creating much better products, but also from the regulator's point of view, much easier for them to regulate you because they don't have to come and see whether you have the right matching FRAs and all of that in your portfolio, right? So that is a waste of time and effort if you're sitting and explaining to the regulator that you actually are matching your balance sheet properly, right? Just, I can check the instrument and say, you got enough of those, finished, I'm done, I'm out of there. Right? So,
See, ultimately, it seems to me that's really the government coming and stepping in.
well, the government has to step in
So,
because...
so the question that is, then, the whole idea was generally, when proving the pension industry, is to give market-linked returns, which are not guaranteed, and the government doesn't have to give any budgetary consideration, anything whatsoever. Here, if the government has to look at the inflation and float these bonds, ultimately we're transferring the risk back to the government anyway.
So the risk is always on the government, and this was the argument we wrote 25 years ago, which is if people retire poor, the government will bail them out. Right? Why? Because these are old people who vote. This has happened in Chile. We proved this by predicting it 20 years ago, that the risk is always on the government. Even Putin, when the retirees protested, backed down. He shoots everybody else. He didn't shoot the retirees, right? So the government always bears the risk. And it's a fallacy to think that just because you went to defined contribution, it's now on the individual, right? No country wants poor people on the street. So then the second question is, if the risk is always on the government, what's the smartest way for the government to manage that risk, right? The government is issuing debt anyhow. We need infrastructure in India. How do you fund that? You don't borrow from the World Bank. You can use domestic savings to fund that as well. And if you design it well, to that gentleman's earlier question about gold bonds, if it's linked to GST, the government is hedged. So you improve government finances, you improve the capital market, and you improve the outcomes for citizens. It's net a win for everybody. So you cannot take the risk away from the government by saying, okay, if people retire poor, the government's not going to do anything. It's always going to bail out poor retirees. This happened in Chile, it happened in Eastern Europe, it happened in all the Latin American countries. And like I said, we predicted it 25 years ago. And it's happened, exactly as we predicted. So if the government doesn't issue these instruments, and they're asking individuals to bear the inflation risk, that's the worst transfer of risk you can do.
No, I agree with you. I'm just trying to get my head around that. Ultimately, it's back to the government. That's the bottom line.
Yeah.
Whichever structure we look at, finally is the government coming in and kind of being the lender of the last resort, saver of the last resort.
With one difference. Today it's implicit. With these bonds, it's explicit. Okay, and that's why I'm talking to the IMF. I'm talking to the India Department of the IMF. They want explicit guarantees because they can monitor how well you're doing relative to that explicit guarantee. When it's implicit, the current government has every incentive to do nothing because 40 years from now, they're all dead, right? It's the problem of a future government. This is exactly the Chile problem. America, Social Security is collapsing, right? Why? Because every government kept saying, oh, I'll be gone in 10 years. Let the one government 20 years from now deal with the problem. Because it was an implicit guarantee. They're going to have to bail it out in America as well. So by making it explicit, you as citizens can actually monitor what your government is doing a lot better than when it's an implicit guarantee where you have no sense of what that number is. Right? So we're trying to make the system more transparent and efficient by these instruments. I think
See, actually, I was about to ask the same question which Sir was asked. See, it is a given that the government is the ultimate insurer and it is being there. But then when we create approaches, can we have an approach of a pool of all the stakeholders together and the pool issuing bonds? So anyway, the government would be there as a second level safety net. But can the primary safety net be the bonds which are issued by the pool? So that would take care of, a lot of stuff on multiple sides.
So that's the tontine structure. And a lot of my friends actually have tontine businesses, but funnily enough, to make the tontine effective, they want this instrument. Because in a tontine, you cannot guarantee a real cash flow, because you're not hedged. The pool cannot hedge inflation risk or standard of living risk. So the only institution that can hedge standard of living risk is again the government. So even if you create these private pools called tontines, this is the only hedging instrument that you have that can allow you to guarantee some kind of retirement income, because otherwise the tontine retirement income is highly variable. Right?
Just one point I just wanted to make, and gentlemen from PFRDA can correct me if I'm wrong. The PFRDA doesn't allow guarantees. It has to be market linked. Any product under it has to be market linked. It's not guarantees.
I'm not the expert on
No,
that.
I'm just taking we can't give guarantees. It's all market linked products.
But this would be a market link product as well, right? Because here, once you buy this market product, it's guaranteed a set of cash flows.
So there is a guarantee at the end.
But it's not by you. The guarantee is actually coming from the instrument. There's a difference.
Which is again issued by the government.
Yes, but it's not your guarantee, right?
No, I understand that.
So it's making it much easier to give a guarantee of income, which is what they need. But by buying the product, you're taken off of the responsibility for providing a guarantee. But it's your responsibility to create the right portfolio to ensure that guarantee, right? So it just changes the dynamic of who's providing the guarantee. Sorry. Huh?
Yeah. Professor, I had a couple of questions. You made one statement during the presentation that equities are not the best way of hedging against the inflation. In the same way, you are saying that maybe the government can index the bonds to the GST collections, which are in a way dependent on the corporate earnings of a particular economy. The GST collections are linked to how the
Actually,
earnings...
let me correct you there. It's based on the consumption patterns of Indian citizens.
Which also leads to the earnings growth of any company.
But that's, no, but the primary source of GST is individuals consuming a product.
Exactly.
Right.
And that consumption is being supplied by the corporates.
But let's start with consumption. Consumption reflects standard of living. Right. So that's why tying it to a consumption-based index is the most effective way to protect for standard of living risk. And it includes both inflation and real standard of living. The corporate side is just the collection agency. The corporate, don't even focus on the corporate. That's the collection agency. The first payment is happening at the level of the individual by what they buy for their consumption basket.
Right. And you are saying that the GST-linked inflation index bonds can be a solution in the longer term?
For two reasons. One is because it will help you protect your real standard of living. So your parents, when they were our age, had no cell phones, no electric cars. Now the basket has changed completely. When they get to retirement, if we don't adjust for standard of living, their quality of standard of living declines. So if the bond is indexed to a GST index, they'll actually be able to hold their standard of living relative to the rest of society. The second most important thing is the government is hedged. Because the government's income is coming from GST, the government's payments are from GST, that's no better hedge than you can find. Today, all other bonds that they issue are unhedged, which increases the fiscal risk that we talked about.
All right. And since you're working with the government agencies, how close is a country like India to issuing an inflation index bond? Because in the past, they have tried and tested that, it didn't work out and they couldn't scale it up. And number two, how would the sovereign rating agency look at the balances of the government? If I am issuing an inflation index bond sitting in 2025, how would they actually map my liability curve over the next 50 years and give me a sovereign rating?
So two questions, right? So the first one is, how close is India to creating this instrument? I have no idea, right? I have no influence over the government. And I hope you as citizens do that, because that's how we did it in Brazil, is the citizens requested it and then the government delivered it. The second question was, sorry, just remind me your second.
The sovereign rating agencies, how would they see this?
So at the end of the day, like if you look at Moody's or whatever, they should actually like this for two reasons. One is that it's actually cash flow hedged, right? Now, I've dealt with the rating agencies when I was there for the World Bank meetings. They're not the most sort of intelligent folks, okay? But at some point, you can get the IMF. So this is one of the reasons I'm working with the IMF, is if the IMF comes in and says, this is much better fiscal responsibility, this is also good retirement security. I just went to the annual meetings of the IMF, and they had a panel on pension reform. It was very mediocre, because they don't know anything about this topic. If you can show them that we've created a much more secure retirement in our country, and it's being financed in an intelligent way that then funds long-term infrastructure which this country needs, they should actually want to rate it much higher than with traditional financial instruments. And remember, you're raising domestic capital. For India to issue dollar bonds is a very risky strategy, right? To come and go to my pension fund clients and say, come and build a road or a train in this country, nobody wants to take that risk. If you're financing it with local financing, you're creating a much more robust economy that's not susceptible to capital market flows, right? from abroad. So this is how you make the country more secure financially with domestic long-term savings. Does that help?
Yeah, thank you.
Sir, question from my side, sir.
Sorry.
Sir, and as one of the authors to this consultation paper, since hearing you since morning, I had a few queries regarding if we are talking about launching the pension credits. Now, in the paper, we had talked about launching it in 3 manners, 1 year, 3 year, and 5 year. Now, sir, considering it from the behavioral angle and from a practical point of view, how to launch it in a pilot, what would your suggestions be? What payout period should we consider? How should we proceed as to if we are supposed to launch this thing in a pilot manner?
So my bias, and again, I'm not an expert on India, so I'll defer to you on that, is I think 1 year guarantee is a waste of time, to be quite honest, right? Because if I get to retirement and I only know what my cash flow is for the next year, unless you're like me with very low life expectancy, that instrument is not valuable. So I would say, I think 5 years is probably the sweet spot. Maybe 3 to 5 years, depending on what it is. And what I like about your design of breaking up my 20 years into smaller slices is, if I don't want to buy 20 years, which is expensive, by buying it in 5-year slices, I actually have a much better ability to finance it. The danger is you have refinancing risk, right? Because come 3 years, if I haven't saved enough for the next 5 years and I'm in good health, so the question I would have for you is, how will you design a mechanism to educate people that even though they have a 5-year guarantee, right? Because, the acronym that you had was very nice, 35A.C.5. The average person on the street is not going to understand that acronym. So you're going to have to develop a tool that conveys to them that you've only covered yourself for 5 years. If you want to cover yourself for the next 5 years, at some point you better start thinking about that decision, right? So you'll have to make your behavioral finance kind of tool much more interactive that prompts them to say, start thinking about locking the next 5 years, right? As I said, 1 year is too short to be meaningful. And that's why I think somewhere in the 3 to 5 year range would be where I would go. And then some way of making sure that people don't stop after they make that first decision because you're expecting them to make a second decision. What I was trying to do with the 20-year bond was they make one decision and then they forget about it, which is also not the greatest thing. So I'm sure there's somewhere in between a much better alternative where, because I'm paying for 20 years, my cost is going to be higher compared to your 5-year. I think there's some way of trying to bridge that gap. But I love your idea of breaking it up. It's brilliant. Whoever came up with that has really done a superb job of slicing up a complex problem into smaller, manageable bits. So well done. Thank you. Does that help?
I had a doubt. Sir, so nominal return is equal to the real return plus inflation expectation plus a risk premium. So in case we have something like India's which takes care of the real return and the inflation expectation, that part is understood. But one of the slides says that equity may not be the best hedge against inflation. So, sir, what other asset class can we as PFRDA look at, given that something like India's is still not here currently, and we'd like to come up with something which provides that guarantee?
So typically for my institutional clients, to try to hedge the inflation risk, they buy into commodities or infrastructure, right? Because those are more likely, because with infrastructure, if it's a toll road, the price of the toll road changes with the standard of living, and so there's some inflation protection there, right? Commodities, India is very dependent on oil, so I would definitely hold oil as a hedge if I'm an Indian citizen. Gold has elements of being an inflation hedge as well, so I would create a basket that's a much more sort of targeted, and somebody will have to do good research on what's the ideal hedge for Indian inflation. It's not a difficult problem. And equity, I was looking at the growth component, right? I would not look at equity as a hedge, but more as how do I get a higher retirement income from participating in the stock market and earning the capital equity risk premium, right? So for me, I would treat equity as a risky asset. I would treat the bond as the real cash flow, and then I would have an inflation component as a pure inflation element. That's how I would build it slightly differently. I would have 3 buckets, or you can fold those last 2 into one, but just so that the inflation hedge is much more closely matched. by some basket that's approved of by PFRDA that says if you have some variation of these assets in this mix, we will consider that an inflation acceptable hedge. But then you go into a little bit of the problem that Chairman Sir has mentioned is, which I think is a brilliant comment, and this was the mistake Chile made, is you should not be in the business of telling people what their asset allocation is. You should not be mandating it, right? That should be the creativity of the private sector. So even though Chile privatized their pensions, they told everybody you have to hold 80% in government bonds. It was basically why are they having the private sector buy government bonds, right? So I think I like the idea that you should not be in the mandation business of telling people what to do, but the guidelines and the framework should be so robust that then the creativity of the private sector comes up with the best solutions, right? But that's a nice project, actually. If somebody works on it, I'm happy to help if I can, on what is the ideal hedge for Indian inflation. I'm sure there'll be enough people that'd be happy to read that paper if you publish it. So, sorry, I'm taking up a lot of time.
One question. When people are making decision about future, they don't know what will be the inflation. And they might be wrong in terms of calculating how much money they need at the time of retirement. And how do you take care of that, is my question to you.
So that's why I designed the bond, because, like I said, I have a PhD from MIT. I've worked with 2 Nobel Prize winners. I have no clue how to forecast inflation, right? I work for an economic forecasting company which was created by a 3rd Nobel Prize winner. I have no clue how to forecast it. So the only way to solve that problem is to have an instrument, which is here. The small black bars are the real guaranteed cash flow. The green bar is what you would have got paid, which is the accumulated inflation until that payment point. So you never have to forecast inflation ever again. By buying the bond, you're already buying your hedge. And therefore, if you don't have that, to your point, most people don't even have the basic financial literacy to understand compounding. You layer inflation on top of that, you're asking for trouble. So if the government doesn't create these instruments, and I remembered an earlier comment the gentleman at the back made, RBI issued INSS, which is a terrible instrument, okay? Because the cash flows that they issued have no correlation to a goal that somebody has, right? This is the same problem we have in America. The Treasury called me up and said, why are we having trouble with our inflation-protected security? Because it has the cash flows on the right. And the retirees want the cash flow on the left. So I would not buy that thinking it's a safe asset. For me, that's a risky asset. So this is where Brazil, by being creative, said, why don't we give people what they want so they never have to forecast inflation again, right?
Thank you.
That's a brilliant question. Thank you.
Sir. Yeah. Hello. So from your experience, have you come across any index which basically mimics the senior citizens' consumption pattern? And probably what government can do is basically club those sectors and then map those sectors to this kind of bond. So it's like a cash flow, the thing you are saying, that cash flow matching would be there.
Yes.
And the consumption pattern of a broader society would be very different from a senior citizen.
In fact, the gentleman I just met in Turkey yesterday, he has actually broken up the GST box in their country, they call it value-added tax, into what is the component of that which is derived from a retiree population, right? So I'm just using this very generically, but if you want to go into the specifics, that's where the government officials can be a little bit more creative and say, within the GST, this component is much more heavily interesting for the retiree population, and we'll index it to that.
It would be a natural hedge for them, right?
Absolutely. No, you're completely correct. So that's where, in the final design of the product, you need some people who sit around the table and say, how do we create the correct product for what protects retirees, when they get to 65. Maybe they don't need Teslas or, fancy cars that drive, 500 miles
But
an
are
hour.
there any index right now globally?
No, so in fact, I'm working with a couple of countries to help design that right now. Okay, but yeah, if you have some ideas, I would love to see that, okay, really, because it's an open area. And this is where, as I said, I think India can be the world innovator to create the first ever index that actually has that element to it. And other countries will happily copy it, I can guarantee you that. So, thank you. That's a great question.
Sir, just to extend that, in fact, here, sir, here. You talked about this index, but for senior citizens, medical cost will be quite a large component, and inflation there could actually be higher than the normal inflation. So, regular CPI or WPI which we use, it could be higher than that, and if government works with that, the spread could be much higher than.
So actually, I've got a solution for hedging retiree medical cost as well, which is a different instrument. I don't think you want to combine retiree medical into a straight-on day-to-day inflation, because they're very different. And the danger of bundling that in is for the people who are in good health, they'll be indexed to something that doesn't really matter to them, right? So you can split that up. They're two different goals, and there's no need to bundle them in. And I have a solution for that, which I can share with you, which is probably a more medical company equity-linked index, which will actually hedge that risk much better. Right? So you can be more creative and split these goals up rather than trying to make it work for everything, right? If you try to make, like they say, perfection is sort of the death of good, right? I think just, focus on good and then let other people find the perfection of whatever. So I need very heavy health insurance coverage, right? Because I'm a heart patient and I've nearly died a few times. So my health basket is very different from somebody who has another disease, right? Cancer. So you can actually customize your health insurance protection and retirement to your specific health condition as opposed to a generic basket. Right? Does that make sense? Sorry. I think I've exhausted everybody. Okay. Thank you so much. These were terrific questions. I hope something good comes out of it.
Thank you very much, sir. And frankly speaking, I had no idea that sir would be taking a quiz, so we are recording. Anybody interested in taking that recording for the quiz sir is going to conduct, we are most welcome.